Welcome to The Explainer. Today, we're diving into an idea that's more than a century old, but is still, right now, at the very heart of how Wall Street tries to figure out what's coming next. We're talking about learning to read the market's own hidden language.
You know, it's the question every single one of us has asked, staring at a flickering stock chart. Is this whole thing just random chaos? Or is there actually a rhythm to it, a pulse? Well, for over 100 years, some of the market's sharpest minds have said, yes, there is a pulse, and if you learn to listen, you can actually follow it. And here it is. This is the big idea that changes everything. The belief that the market isn't just reacting to what's happening today, it's a barometer, actively trying to forecast what's going to happen tomorrow. This simple, powerful concept is the foundation of what we call the Dow Theory. So here's our game plan. We're going to meet the pioneers who came up with all this. Then we'll dive into the market's three core movements. Think of them as the tide, waves, and ripples. We'll get into the crucial rule of confirmation, learn to spot some subtle chart patterns, and then ask the big question. Does any of this still matter today? All right, let's start at the beginning with the people behind the theory. To really get this, you have to understand it wasn't cooked up in some lab. It was discovered over decades by people who are just paying incredibly close attention to how the market actually behaves. So it all started with Charles Dow. Way back at the turn of the 20th century, he was the first to really suggest that the market as a whole has a trend you can follow. After he passed away, his successor, a guy named William Peter Hamilton, spent nearly 30 years testing and fine-tuning those ideas. And then finally, in 1932, Robert Rhea went through hundreds of their writings and distilled it all into the Dow Theory that we still study today. Okay, now for the absolute core of the theory. Dow and his followers didn't see the market as a machine. They saw it as an ocean, with a powerful tide, big waves, and little ripples, all happening at the very same time. First up, you've got the primary movement. This is the tide. It's the huge underlying long-term trend of the whole market. Are we in a bull market where the tide is rising for months, maybe even years? Or are we in a bear market where the tide is slowly going out? The theory says that understanding this, the direction of the tide, is the most important thing for any investor. Now, pushing against that tide, you have what are called secondary reactions. These are the waves. So, in a big bull market, this is a sudden, scary drop that makes everyone panic. In a bear market, it's a hopeful rally that makes people think the worst is over. And this, right here, is where most people get tripped up. These waves can feel so real that they trick you into thinking the whole tide has turned, when it's really just a temporary pullback. And finally, on the surface, you have the daily fluctuations. These are the ripples. This is all the day-to-day noise, the chop that fills up our news feeds. And the theory is really clear about this. Obsessing over these little ripples is a massive mistake. They tell you almost nothing about the real direction of the tide or the waves. Hamilton had this brilliant way of describing it. He said, "The advancing tide shows wave recessions, although each succeeding roller comes further up the beach." Just think about that image. You're at the beach, the tide is coming in, you'll see a wave crash and then pull back, right? But the next wave that comes in goes a little bit further up the sand. That's how you know the tide is still rising, even with those pullbacks. So that leads to a really important question, right? If these waves are just temporary, is there any way to know how far back they might pull before the main trend, the tide, takes over again? Well, yeah. The pioneers of this theory studied this for decades, and the data they collected show some pretty fascinating patterns. And here's the key range they discovered. A typical secondary reaction, or a wave, will usually retrace somewhere between 1/3 and 2/3 of the last big move. So, let's make that real. Say the market has a great run and goes up 30%. A totally normal, healthy pullback, a wave, would be a drop of somewhere between 10 and 20% before that main upward trend kicks back in. And you can really see it in this chart of the historical data. Now look, it's not a perfect science, nothing in the market is, but check out where these numbers cluster. More than half of all of these pullbacks in history have landed somewhere in that 25% to 70% retracement zone. It gives you a really practical benchmark for what a normal correction looks like. Okay, so we've got the tide and the waves. But how do you know for sure that the tide is actually turning and you aren't just getting faked out by a really big wave? Well, that brings us to what Hamilton called the theory's single most important, indisputable law. The logic behind this is just powerful common sense. Back in Dow's day, the economy had two main engines. You had the industrials, the companies that made all the stuff, and you had the railroads, the companies that shipped all the stuff. Dow's big insight was simple. You can't have a truly healthy economy if only one of those engines is firing. For a trend to be legit, the makers and the shippers have to agree. They have to move in the same direction.
So here's how that plays out. For a bullish confirmation, you need to see the industrials hit a new high and the transports hit a new high too. That means the trend is strong. Same thing on the downside for a bearish confirmation. But the real signal, the one you really need to watch for, is non-confirmation. This is when one average, let's say the industrials, makes a new high, but the transports don't. That disagreement? That's a huge red flag that the main trend could be running out of steam.
All right, let's move on. Beyond just the big trends, the theory also gives us tools for spotting the subtler signals on a chart, specific little patterns that can give you a hint about what the market might be about to do next. And one of the most important patterns is something called a line. This is when the market just goes dead flat. It trades sideways in a really tight range for weeks, sometimes longer. The theory says this isn't just boredom. This is a battle. It's a period where the so-called smart money is either quietly buying up shares, that's accumulation, before a big rise, or they're quietly selling off their shares, that's distribution, before a drop. The direction the market breaks out of that line tells you who won. And this chart, which is from Robert Rhea's original 1932 book, is just incredible. Each of these little boxes shows the absolute bottom of a major bear market. And look what you see in almost every single one. These flat, sideways periods. These lines of accumulation forming right at the lows. It's fascinating. In almost every case, this quiet little pause was the launch pad for the next huge bull market. And the final piece of this puzzle is volume. The amount of shares being traded. The best way to think about volume is as the market's emotion. In a healthy, confident bull market, you want to see volume get bigger as prices go up. That's real enthusiasm. On the flip side, in a fearful bear market, you see volume spike on the days prices fall. That's real panic. So any rally that happens on low volume, the theory says you shouldn't trust it. Volume should always confirm the primary trend. Okay, so we've gone through the history, the movements, the patterns. But let's be real for a second. This whole thing was developed in a world of railroads and ticker tape. Why on earth should we care about it today in our world of supercomputers and instant information? Well, because almost every single tool that modern traders use is built on top of this foundation. The idea that the market even has a trend? That comes from Dow. The concept of looking at long-term, short-term, and medium-term trends? That's just the tide, the waves, and the ripples. Looking for confirmation between the S&P 500 and the NASDAQ? That's just the modern version of the industrials and the rails. These aren't just historical fun facts. They are the bedrock principles of all technical analysis. And that really leaves us with the ultimate question, doesn't it? In this age of AI and high-frequency trading, can a theory based on 19th century railroads possibly still offer an edge? The Dow Theory's answer would be a resounding yes. Because while the technology has changed beyond recognition, the one thing driving it all hasn't changed one bit: human psychology, greed, and fear, hope, and despair. And as long as those timeless emotions are what create the market's tides, waves, and ripples, maybe learning to listen to its oldest language is more important than ever.